and it's been announced, mammoth cut. I mean, many were expecting that the central bank will decide to stay same, I mean, maintain the 28%. But what we understand is that that rate has been cut by 300 basis points. And that's what we'll be analyzing here on Beyond the Numbers. We are asking a very simple question. What is actually driving the decision to cut the monetary policy rate by 300 basis points? And before we even start, what are we even talking about? When we talk about monetary policy rate, Winston, what are we talking about?
We are discussing, basically assessing the cost of borrowing to commercial banks from the central bank's perspective, and that has been a key decider of how the cost of loans are on the market. Businesses have been anticipating or asking the government to review the policy rate consistently. For the past few years, we've seen policy rate hovering around 30%, and the call has been the cost of borrowing has been increasing because businesses need cheap capital to advance the operation, to advance investment in key structures and operations. And that has been a key challenge. Looking at the economic growth trajectory, we've seen the construction sector, the SME sector, and that has been the burden for most entrepreneurs. And this development seems to be much expected. However, there has been basic analysis before the announcement that the central bank was going to reduce it by 200 basis points, somewhere even anticipating 150 basis points, even some were calling for 700 basis points, hoping because of the economic conditions we are to experience. We'll get to the numbers to understand some of the key factors that probably led us to where we are as a nation. So far, 25%, 300 basis points. Was it a miracle? That is yet for us to understand the dynamics.
Caleb, 25% is the rate now. From 28% now, we are talking about 25%. Some 3 percentage point drop, and that's a 300 basis point. What you expected?
Well, I didn't expect it to be this steep because if you go back, I went as far back as 2010. This is the steepest it has gone. Prior to this, it's just 2% or 200 basis points. But from 2010 till now, this is the highest we've seen, the highest drop of 3% or 300 basis points. Before the governor made a decision, Winston and I were talking on the show, and then we predicted it's drop, but then we didn't think it would go as low as 3% or 300 basis points. So I think it's steep, but if you look at the indicators, it's all pointing to a reduction and then a cautious one. And I think the bank looked at some of the various indicators and decided that 3% was cautious enough.
I mean, this is actually the governor's, I think, third or second decision, right?
Yeah.
Where the first one, when he decided to hike the rate.
They were surprised.
Well, surprised from 27 then to 28%.
Yeah.
So he increased the rate by 100 basis points, now back to 25. So in net terms, it's about 200 basis points back to where what he actually inherited. But before he even arrived at this figure, and monetary policy rate, they had to actually consider so many factors. A lot of data must be taken into consideration. They have to take a tour around the world and see what.
Sure you had the privilege of sitting
Absolutely,
through. So
I mean,
let the viewers understand what.
Yeah, I mean, it's a very technical meeting where, I mean, it's not one person's prerogative to possibly set the rate. You have to listen to the data argument, and the monetary policy rate committee members would then decide on where the direction that the country should go. And in terms of the data presentation, one thing that, the chorus of almost all the presenters who came to possibly paint a picture of the economy, whether in the local space or around the external space, was that when you come to the local side, things looked very, very bright. And I went back to the press release that was put out. The governor, the quote was that the economy was buoyant in the first quarter of 2025 with an annual GDP growth rate of 5.3% compared to 4.9% in the same quarter of 2025. This is in the local space. And one thing you realize is that they were very confident about what was happening in the local space. And they spoke about so many economic indicators and how far we've come in the first half of the year. And you could see that sort of confidence in the economy, in the local space. But we will analyze the local space and possibly go to the international and see whether the decision to cut the rate by 300 basis points is actually justifiable. I mean, first destination is inflation. How far have we come? Now, 13.7%.
Yeah, so one of the aims of the policy rates is to control inflation. And when there's so much liquidity in the system, you need a higher monetary policy rate to mop up the excess liquidity. And the banks still believe there's excess liquidity in the market, which is why I think that's why they didn't go down further. And then also, if you look at the other instrument the bank has, we have BoG bills and we have the treasury bills as well. So the treasury bills and the BoG bills, for some time, BoG bills were so much higher than the treasury bills. That's why the government was losing out on the treasury bills.
Yeah.
And now they brought the BoG bills down to the treasury bill market, to the treasury bill rate level. So when they bring it down, you should expect that the policy rates also come down to try and match up the system. And we've seen inflation drop from 20s to 18, now 13.
13, yeah.
And the governor was even saying that from the data they are seeing, July will even go down further. And before the end of the year, it was 11.9% target. Right now, they think they can meet their 8 plus or minus 2% target. So if you moving forward, inflation is kind of tamed, barring any other external circumstances that might push inflation up again. So inflation is looking good, considering where we came from. We came from the 20s. It was very sticky around the 20s.
That were as high as 54%, right? 2022, December.
54%. And then when it came down to 20, it was very sticky. They didn't want to go below the 20 mark. So we stayed at 20 for a couple of months. But then from 20, it just jumped down to 18, now 13. So with this momentum, I think inflation should go down further. And then from what the market is seeing, I think it is going down further.
Now, the tour first is the local space, and we are starting with inflation. What we are discussing is Bank of Ghana's, major monetary policy rate cut. And we're asking the question, what informed the drop? And Winston, the first destination is inflation. The picture has been painted by Caleb, 13.7% from the highs of 20s. Usually, it's not just about the drop, right? But it's about asking yourself, can you maintain it? Can you pull it down? The governor seems to be very confident looking at the economic, some of the economic indicators and saying that, well, we could hit single digit by the end of the year. 13.7% inflation. Do you think this was enough to warrant 300 basis point cut in monetary policy rate?
The target of at the end of the year, like you mentioned, is something that the central bank governor is quite optimistic about. All projections point to a positive outlook for inflation, but there are key external factors that may come into play. Already the 1%, the 1 Ghana cedis on petroleum levy is one thing that people were quite not optimistic about how it's going to trigger the price of fuel, which has a ripple effect on price of commodities in the market, which has also a ripple effect on transport fares. And these are key factors that are also captured in the inflation basket. And most of the times, people also look at the direction of the inflation, especially the price of food in the market, the rainfall pattern. Last year, December, somewhere, we saw the drought season in key regions in the country. That seems to be the food basket of the country. And if you look at the inflation basket, those prices of those commodities kept increasing every month, every week, and it became a key challenge whether the reflection are going to be quite realistic on the market. That is when government came out to say, let us push prices down because of the differential we felt from the first quarter to the second quarter of this year. And they believe, should the numbers look good, it is high time. Already we are seeing the cedi appreciating by 42.6% on the domestic market against the dollar and also against major global currencies. And all these gives a bit of a confidence to the business community, understanding that with the central bank decision to cut down the policy rate, with loans being cheaper for businesses, government is in place to ensure the monetary policy and the fiscal policy, both of them are intertwined to ensure there's prudent and sustainable. Businesses are all more interested in how government can keep this stable. Yep. For business community, they need stability to ensure planning and forecasting. And most people are anticipating, especially the IMF, is anticipating that government should have a cautious positive growth in the fourth quarter because they are not quite sure how government will sustain the growth trajectory. Already, the caution has also gone to the government's, let's say, policy that has brought a bit of light in terms of how it's being managed, the gold board policy, where the domestic gold is priced and controlled in terms of the revenue outflow, which we'll come to shortly in this analysis?
Well, I mean, talking about inflation, there's no way you can talk about inflation without bringing in exchange rate. And so from inflation, we move to one indicator that they looked at the Monetary Policy Committee, 40% plus appreciation against the dollar. That was a big assurance, and it ran through almost all the technical presentations that were actually made in the 3 days, and everybody was very confident that we had what it takes to actually sustain this. And in fact, looking at 40% plus appreciation of the cedi, the governor has already made a point that, well, they can actually sustain this, and do not fear, we have what it takes to actually keep the cedi within the 10 to 12 cedis band that the president actually mentioned. 40% plus, enough to around 300 basis points, cutting policy rate.
Well, it's not just about the cedi, but other factors as well. And we have inflation in check now, compared to where it was before. Now with the appreciation of the cedi, this is massive, and it has taken away almost all the depreciation in the past year. So moving forward, if this can be consolidated and protected, I think the policy rate should come down to about 20%, because most of the inflation passed through is from
the
dollar.
rate side.
Exactly,
yeah.
Especially because of the crude imports. Once it starts from the petroleum side, it passes throughout the entire economy, because transport fares, food products, and even food inflation is still elevated. It's still higher than the normal inflation rate. So controlling the exchange rates is very key. And even today, the dollar has slipped down a bit because of Trump tariffs. And then I think we'll get to the tariff.
Yeah, we'll get to the tariff, the external side. But I mean, it's important to also note that after exchange rate, what you need to talk about is your debt position. Because they don't just look at inflation and exchange rate, they also look at the public debt as well and the capital markets. There is a whole presentation as well also on the capital market. And if you look at our debt situation, looking at it from the debt to GDP ratio, comparing first half of last year to the first half of this year, we've moved from 63.3%, now talking about 43.8% debt to GDP ratio. Definitely because of one factor, or significantly because of that factor, exchange rate situation. And this has given the government also some sort of weight and some sort of confidence that with all of these factors in check, you can now begin to reduce the policy rate to 300 basis points. Because the last time that they had the MPC meeting, there were calls that, why don't you reduce the rate? Inflation is falling to 18%. But the governor said that, in that presentation they put out, they said, we still need to do some form of consolidation. We still fear that the external side, we are still looking at it. It was in that same quarter that we saw the Iran, Israel war and all of that. So the external side was very, very hazy, and it made it very difficult for them to take such decisions. But moving away from the debt side, one thing that we also need to focus on is, because exchange rate is so important, you need to look at how much is coming in as inflows for the Bank of Ghana to have that sort of confidence that they can maintain the cedi and as well cut policy. We're talking about export revenue, comparing first half of last year to first half of this year, Winston, we are talking about $8.9 billion as against 8 billion, almost 14 billion. The jump is crazy. Is this some of the things, when you look at this, do you think that it actually warrants that 300 basis point cut we are seeing? Or you think that, it was too sharp, possibly we are seeing this, but we still need to do some form of consolidation?
One thing you always get, no matter how good you are as a student, your lecturer will write more room for improvement.
Yeah.
That is one thing that I'm certain that government has to focus on, and that is basically telling you that if we should put structures in place, assess the various elements of our trade component, we can do more. Over the years, we know the cocoa sector has been bedeviled with a lot of challenges. Currently, if you assess the cocoa market, which very soon, by September, they're going to take the farm gate price, and the key assessment, which has become a quiet issue, which we discussed quite not long ago, is now that our quality proposition as a country is really acceptable in the international market as against Cote d'Ivoire's quantity supply. Already, we are losing out, and there's key challenge that certainly the weather pattern is going to affect our output. But as to whether we can make as much as we can, considering the outgrow in terms of global price increase, we are not making much, then that is a good conversation for us there. So we're hoping that we can even benefit astronomically from our trade outlook, and the surplus is something we can do more.
In fact, looking at the positive side and the good news.
I think one thing that will probably affect us shortly will be the trade tariff. But we'll get back to that.
We'll get to the external shocks, but it's important to also note that the goodwill and the good story, the positive stories we are seeing in the local space, all backed by commodities. Yeah. So you have cocoa, first half revenue compared to last year. In fact, if you look at, we are breaking down the export revenue, and the top three commodities that we are talking about. Cocoa, for instance, has moved from $763 million to $2.2 billion if you're comparing first half. Big difference. Same story when you talk about gold, talking about 4.7 as against 8.4. Come to oil, the only commodity that we didn't really, get what we got last, half of the season or half of the year, 1.98 as against 1.36. In fact, we have said on this show over and over again that it is good to build the economy on the success side of gold. But it's also risky if you continue to build your economy on the wheels of global commodity prices, because we all know what has happened. There are historical antecedents to this. But I've showed you three. Two have actually improved or actually increased significantly. Gold, for instance, more than half. Cocoa, also same story. And there are other success stories like the gold board. I have seen the data. And when the debates actually started in the room, these were some of the commodities that gave the committee some sort of assurance that, look, we can go ahead to possibly drop the rate, because maybe in the local space, we have what it takes to absorb the shocks. Talking about 8.8 billion, in terms of total export, talking about now 13 point something. Do you think that what we have currently can absorb any form of external shocks that will possibly come? And note that we are in the last half of the year. Government's expected to start spending
60% of the.
How is this going to affect us? I want your thoughts on that.
So like you rightly said, we need the inflows to protect the city. And gold, cocoa, and oil just accounts for over 80% of the total exports and the total revenue, total dollars that come into the economy.
Yeah.
So protecting this is very important. But then we know cocoa prices, there's a sort of shortfall in cocoa. So cocoa prices should remain elevated for some time. So we are good on that side as long as we can maintain production. If production drops, we'll be in trouble.
As long as we do spot sales, right?
Exactly. We stop the forward sales and then the syndicated loan and all of that. So right now, we buy it and then we sell and we get all the proceeds, which is good. So moving forward, we have to just sell off the cocoa beans that we owe, so that right now we can continue taking everything that we sell. And then with gold prices, currently they've been coming down. From in April, it went as high as $3,500 per ounce. Right now it's around $3,200. So it's coming down, but it's still high.
Yeah,
last year was about 2,000, now it's 3,000. So obviously we are going to be benefiting from that side. But like I keep saying, gold prices are never stable. It depends on what's happening in the U.S., most importantly, and with trans policy.
The governor said there will be hedging, right?
Yeah, they are beginning hedging, I think in September or so, which is a good step. But then it's not enough, because what happens when gold prices go down, and they will, because this is a high because of what we are seeing with the geopolitics and all of that. So we have to really consolidate the gains, and then we have a refinery. We have to get a refinery up and running to just gain as much as we can at this moment and then before the drop.
I think that is the last bit of the gold board initiative, moving from just buying and exporting and getting the inflows to refinery, because currently we are the highest producer of gold in Africa. How do we consolidate these gains, possibly with the refinery, Winston?
Already the UAE is our biggest consumer market of gold, and we've been giving them raw gold for several decades. China, India are also our key market acceptors, especially exporters, and we think that is critically necessary for us to prioritize adding value. Just as Caleb mentioned, a refinery should not even be a decision to be made. It's a decider for us as a country. We've been mining gold for several years.
Without a refinery.
I mean, it was 60 years of independence.
We had Thor before we even discovered the oil. So the key issue now is, what are we missing? We should basically stop the politicizing our key economic structures. These are resources. Our cocoa processing company has been a key challenge. If you go and check their books, it doesn't look too good.
And speaking of cocoa, even the local producers struggle to get cocoa beans.
Exactly.
Because we export almost everything we get. So how do you build the economy locally if you're exporting all the cocoa beans you get?
And to turn things around, we need to start adding value. Too much of buy made in Ghana. If you don't buy made in Ghana, consume made in Ghana, it's difficult to even, if you look at the cost of cocoa, normally children and everyone should be buying. But if you go to the market, domestic prices are more tenable. Let's bring it, domesticate the prices. Let's target African markets and ensure we hit the African market before we even hit international market.
One factor, I mean, talking about inflows, and these are the factors that helps us to build reserves, right? So if you look at the net position of our reserve, I love to look at it from that angle. You can talk about the global, the gross reserves, but net, it means that if you take away your oil funds and then your incumbent assets, what do you really have? As of the first half of 2024, we're about $4.5 billion, dollars. Now we are talking about 8.8 billion, all simply because of the success story of gold, as well as the domestic gold purchase program. You remember that was introduced by the former administration. All of this helped us to build the kind of reserve we have at the moment. But in terms of the rate of increase, Caleb, just compare this. 4.5 billion in terms of net international reserve to 8.8. Doesn't that surprise you?
Well, it doesn't surprise me because of the fact that it's coming on the back of gold. So once gold prices are high, last year gold prices were around $2,000. We have $3,000 just this first half of the year. So doing that, if you maintain your production, you're going to get almost 60% more than you got last year, almost double self. So the gold prices are what's making this, making us in a good position, and we need to consolidate against. That's what we keep saying, because they reached the peak of 3,500 in April, and they are dropping. And if you look at the trends, it might keep dropping further, even though it won't go down back to about $2,000. It will keep dropping. So we need to consolidate it now, because in a few months we might go back. Maybe next year probably it will just go back to the 2,000, because the 3,000 per ounce is an outlier.
Well, I mean, talking about the success story in the local space, there's one thing that the Bank of Ghana fears the most, and that is the global shocks. What did they say when they put out that press release? They said that global economic outlook has become more challenging with increased economic and trade policy, and the key word is uncertainties. Then they went ahead to say, Winston, if you can take this for us.
The prolonged bilateral tariff, which is very critical, tariff actions and retaliatory actions amid rising geopolitical tensions are projected to constrain global growth, and this is a key conversation.
In fact, very, very important, tariff.
We don't know who they were talking about.
Yeah, we all know. I mean, in fact, the big elephant in the room has always been the U.S., right? And there was one thing that I realized, that even before the monetary policy decision is made, the decision is made, right? They take a tour around the world and they look at what other central banks are doing in terms of their decision and all of that. Remember that fight between Trump and Jerome Powell?
That's fighting. I mean, because on Wednesday he decided to maintain.
Exactly, and Trump was expecting a cut, right? But in fact, their biggest fear is the tariff. And just talking about tariff, just barely 24 hours after we decided to cut policy rate by 300 basis points, the U.S. decided to slap us with a 15% tariff in terms of trade. The first projection, or the first number that was given to us, or slap on us, was about 10%. And because of maybe our inability to negotiate proper, we've been added to those possibly in the middle belt, now talking about 15% tariff. These are some of the shocks, right? Because this will have a pass-through effect in terms of inflation, import bill, and all of that. Wrapping up, gentlemen, your final comment, especially on the external front.
South Africa is 30% tariff hit. Ethiopia 15%, just as us. But the key decider now is where will be our direction. Now the key, we shouldn't just worry about the tariff. We should worry about exploring other markets, Asian market, China market. Yeah. China has been a good trade partner for Africa. We need 4.4 billion export in U.S. market. But if you look at trade with China, it has increased, and they have been key supporter of African projects in key development areas. So I believe we just have to move to Europe, China, and explore our advantage. Already, South Africa tried to negotiate. It did not end up well for them. And I think we have to get to that point where we can...
Caleb, your final comments?
Well, I don't think the 15% will affect us heavily because crude oil is exempt from the tariff. And crude oil accounts for about 70% of our exports to the U.S.
Well, gentlemen, unfortunately, this is where we end Beyond the Numbers. We'll be back Wednesday, 2 p.m. and Friday, 5:30 p.m. Thank you so much for being part of the show. It's the big policy rate cut, and we've been taking you through what actually drove this decision. But the big fear still remains the external factor. See you next week.